Well, that is very insightful, particularly as we start to grow our businesses, start looking for bigger check sizes, figuring out what we want to do next, what we should be focusing on in order to attract more sophisticated capital and investors into our businesses. And I always kind of am looking around the corner and having conversations with these people and saying, hey, I'm not raising $30 million quite yet, but once I am, what things should I be asking? How do I start to build my business in such a way that I can be prepared for that type of thing? And next up, we've got Veena Jetti, who is a longtime friend. She's been on the stage quite a few times before. She's one of our judges in the Pitch Slam as well. She's talking about ways that sponsors lose money, because as business owners, it's very important that we protect our capital. And I know people who've said, hey, I lost $400,000 in earnest money on this deal. Or we had a whole bunch of pursuit costs and spent money on geotech, phase 2, and ultimately we didn't have the zoning that we needed on something like that. All these different things that can go wrong, and when we lose operating capital like that, it can set us back years, which we don't want to do. So let's give it up for Veena Jetti, who's going to help us kind of explore this a little bit.
Thank you for having me back. Thank you. Hello, good morning, Salt Lake. How are we today? Are you guys still sleeping? Partied too hard last night at the VIP event. Good morning, Salt Lake. How are we today? Amazing. I'm so excited to be here. As he mentioned, I've been on this stage many times. You will see me many more times throughout this week. But today I'm talking about costly mistakes and how we can avoid them. We all want to learn about that, right? Right? All right. You guys, I'm going to make you do work. And if you guys aren't going to do the work, I'm going to make you get up and do exercises. So just stay with me here. Give me some energy here, okay? All right, so for those of you that don't know me, I'm Veena Jetti. I'm the founding partner of Vive Funds. We've bought and sold over $1 billion of multifamily within my own portfolio. We've raised a little bit over $400 million from retail investors, which means investors just like you and I. I'm also the founder of the free Facebook group, Mastering Multifamily with Veena Jetti, and the multi-mastermind community as well. I'm also a contributor for Forbes and all the places. If you Google me, you'll find me. But look, it's not a secret. We're in the middle of a storm right now, right? This is a part of the market cycle that we have not seen in many, many years. And we enjoyed a bull run for a very long time. And now we're starting to see the downside of the market cycle. And when we're in a storm, we have the opportunity to react in one of two ways, okay? We can react as the cow or the buffalo. Let me explain. In Colorado, it's one of the few places in the world where both cows and buffalo exist in nature. And most storms move from the west toward the east. Okay, and when a cow hears the storm, it senses danger. And it immediately, its ears perk up. It goes, okay, there's a storm coming. So the storm's coming from the west to the east. And the cow, they're not known for being the fastest land animals, but it takes off running, and it starts running east, away from the storm. So what ends up happening is the storm comes from west to east, and the cow is running toward the east. So both of them are moving in the same direction. So what happens is, because they're not fast, the cow is running in the storm catches up and stays over the cow as it continues moving away from the storm. Now the buffalo, on the other hand, does something different. The buffalo hears a storm coming and stops. It stands still and it waits. And it waits for the storm to reach the crest of the Rocky Mountains. And when it reaches the crest, the buffalo does something different than the cow. It runs to the west and runs directly into the storm. So what happens is the buffalo's running into the storm's moving this way, and so now they're passing over each other. And so by virtue of waiting and running into the storm, the buffalo spends less time in the storm, less time in the pain of the storm. And what I think we can learn, especially as multifamily operators or real estate operators in this environment, is neither the cow nor the buffalo could control the storm. It couldn't control the timing. It couldn't control the intensity. But both knew that a storm was coming. And how they reacted is what changed the outcome and the pain that each had to suffer. And so for us as multifamily investors, we know we're in a storm. we know we're possibly going into a bigger storm, right? And we can't control that. I can't control the interest rate. I wish I could. It would be a lot better than it is right now, but I can't, and neither can you. But what we can do is we can control how we react to that storm. And by controlling how we react and running into the storm and acknowledging that these storms will happen, it allows us to have the chance to show up better for our investors, to make better decisions. But in order to do this, we have to develop a growth mindset. We have to keep learning, right? Because this is a lifelong process. You're not going to be done learning, right? Does anybody here ever say, like, oh, no, I know everything there is to know about multifamily? No, right? That would be totally ridiculous if someone said that. I've done over $1 billion in transactions, and I'm still learning new things every day. Every time we do a deal, I'm learning new things. So there are 4 stages of learning, and I learned this from my mindset coach, Rosie Noel. I work with her on a regular basis. For the last couple years, I've been working with her almost 5 days a week. And there are 5 stages of learning. So the first stage of learning is unconscious incompetence. Okay, so this is for anybody that's brand new, right? Think of it when you're driving a car. You first get into a car, you've never driven before, you don't know what you don't know yet. Okay, there's buttons and gears and shifts and all these lights and bells and whistles, and you're not really sure what all of them are for because you just don't know what you don't know. Okay, that's the first stage of learning. If you're there, that's okay. It's okay to feel overwhelmed, it's okay to feel completely lost. That's normal. Then you get to the second stage of learning, which is conscious incompetence. Okay, so conscious incompetence is when, okay, now we know there are things we don't know, right? We know that there's, a gear shift here. Maybe we're not entirely sure when to use it or how to use it properly or the best use of it. Or there's lights that come on in the car. I mean, there's still lights in the car that I'm not entirely sure what they mean, but I know that that's a sign for me to take it to someone more knowledgeable than me, right? But that's more in conscious incompetence. Now we know there are things that we don't know. Okay, then we get to the third stage, which is where we start to experience more mastery. Okay, so conscious competence. This is where we can actively think of the solutions, of the answers. We can actively anticipate problems. So when you're driving a car, right, you know there's a stop sign, you know you need to start pressing on the brake about 30 feet out to slow down in time, right? That's conscious competence, but you're actively thinking about it. When we reach true mastery, which is the 4th stage of learning, it's unconscious competence. Now, this is when you don't need to be thinking about pressing the brake, right? Your muscle memory is taking over. You're just doing it involuntarily, right? Now you can maybe listen to the radio while you drive because you have mastered the art of driving. So most of us are going to hover between the 3rd and 4th stage as we go through this journey. Now, the bad news for all of you that are ambitious is once you reach the 4th stage of learning, you're going to go, but there's something else I could learn. And you're going to push yourself to go back to stage 1 and learn something entirely new. How many of us have done that in here? Yeah, okay. This is a room full of ambitious people, so I feel like most of us have probably done that. And you're like, oh, now I've learned multifamily. I'm a master in multifamily, but I don't know how to speak Japanese yet. Right. And so that's how learning goes, but it's okay. And the reason I point this out to you is because if you feel like you're overwhelmed, you're uncertain, you're unsure, if you have imposter syndrome like so many of us do, it's okay. It just means you're in a various stage of learning and you're going to continue moving, and it's okay to do that. Most of us will forever hover there. But one of the most important parts of learning is actually unlearning what we knew. Unlearning what we thought to be true. So I recently read a book called Think Again by Adam Grant, and by recently I mean 2 weeks ago I finished it. It's easily one of the top 5 books I've ever read, so highly recommend this read for anybody. What it's about is when you get to mastery, we can get stuck in an overconfidence cycle. So what that means is some of the principles that we have applied that worked really well in 2020, 2021, even 2022 are no longer working now. And instead of unlearning what we had learned back then and moving out of that, we get stuck in a cycle of overconfidence. Think Again puts into perspective the way that we can show up better by unlearning and questioning what we thought to be true, what we believed to be true, or what used to work. And there's a really good story about this in the book that I wanted to highlight for all of you. It's a story of BlackBerry. We all know what BlackBerry is? Yes. Okay. I was like, maybe I'm just aging myself because I was around when they were first out, and that's when everyone was getting phones. But Mike Lazaradis is the one of the co-founders of BlackBerry. So in 2009, BlackBerry had 50% of the market share. Okay, that means one out of every two people you knew had a BlackBerry. Everyone was using them, right? Presidents, celebrities, athletes, you name it, they were using the BlackBerry because it had a physical keyboard. Okay, they had a $38.6 billion market cap in 2009. But what happened in 2007? The iPhone was introduced, and the iPhone introduced a touch screen. Now, Mike, who had experienced rapid and wild success with his physical keyboard of the BlackBerry, went into an overconfidence cycle and said, no, my clients, my loyal customers, and they were loyal, they're not going to want a touch screen. Spoiler alert, he was wrong. Uh, but he was overconfident in how he had built his business. He was overconfident in the thing that had worked so well for him historically. And instead of unlearning what he knew and thinking again, he doubled down on the physicality of the keyboard. And so what happened was by 2014, the market share dropped to less than 1%. The market cap went down to $5.78 billion, which is still a lot, but not when you compare it to where it was just 5 years before that. So that means his failure to rethink cost him $33 billion in a span of 5 years. We don't want to be like that. Right? We want to make sure that we are leveraging new strategies and new ways of thinking in order to show up better and make sure we're avoiding principal loss. So there are 5 mistakes I see often, and I'm going to share those with you and what some solutions might be. Now, I've also stopped using the word best practices because, as I read in that book, when we say the word best practices, it means that there's no better practice out there. And that's just simply not true. We just are not looking for it when we say best practice, right? So it's a good practice. It might be the current best practice, but that's just because a better practice hasn't been established yet. So the first mistake we see is in debt structure, right? How many of us are underwriting deals and can't get any deals to pencil because the debt is just too expensive? No one? Are you guys underwriting deals? Yes? Okay, so how many of us are seeing deals where the debt's killing the deal? Okay, most of us, right? And with good reason, because interest rates are extremely high. Putting fresh debt on deals can be really difficult. So, one creative solution to that is to assume deals that have low fixed rate debt. I'll give you an example, and they do exist. Last year in Q4, my JV partner, Ali Perlman, and we acquired a deal in Dallas, in Addison, which is one of the hottest submarkets of Dallas, at a 2.59% fixed rate. Okay, and that wasn't a one-off. The year before that, we assumed a 2.77% fixed debt deal for 12 years in Phoenix. So these deals exist. You have to look for them. So when you are looking at debt structures, if the current debt that you're looking at doesn't work, go out and explore alternative options for debt or start targeting deals that have better debt structures that will pencil. The second is variable below the line expenses, right? So those of us that have variable rate debt from 2020, 2021, earlier, what we saw over the last 2 years is our debt pretty much doubled, right? For most of us, our debt doubled. The mitigation for that, and one of the things that a lot of sponsors that did not have rate cap insurance are seeing is their debt is just so high they can't service it anymore. So anytime you're going into variable debt products, you want to put rate cap insurance on those assets because it prevents the risk of interest rates continuing to climb. Okay, so that's the second one we want to do. The third is capital structure. So when you are looking at your capital structure, and this is something that I see more often than not helping solve the issues of deals not underwriting, is looking at your capital structure. How can you stack your debt and your equity differently to still allow for downside protection for your investors, but also create the upside and the alpha that they need in order to get the returns that they're targeting? I'll give you an example of this. One way to do this is to go back to sellers, especially on those smaller assets like 150 units or less that are owned by mom and pops. One of the things you can do is ask them to carry back a note. I had a deal that we made an offer on, and they were hesitant to carry back a note. But there was about $2 million in capex and deferred maintenance that needed to be done. And so we went back to the seller and we said, okay, look, we'll put $2 million into an escrow account. You finance it, we'll put $2 million into the escrow account, and we will use that to draw down for capital expenditures, and you take a second position lien after the senior debt. So there's different ways that you can look at structuring it that doesn't have to be a traditional seller finance deal or a traditional debt deal. So thinking about your capital structure and understanding structure will help you structure deals more creatively so that you can acquire more deals that wouldn't have been possible without creative thinking. Number 4 is volatility or a down market where, there's talks of whether we're going into a recession. I think at the beginning of next month, we'll likely see that depending on what the jobs report shows. And based on that, we can be underwriting for longer hold periods. So for example, that deal we acquired in Phoenix with a 2.77% fixed interest rate for 12 years. I can basically hold that deal and do almost nothing on it for 12 years. That gives me enough time, it gives the market enough time to recover before I have to sell or relever or put fresh debt on the deal or exit the deal, right? So giving yourself time is really important because what's one thing we know about real estate? It always comes back up, right? It's cyclical. So even if we're in a down market, it will come back up. We just need to give it time to catch up. And so underwriting it for longer hold periods and setting that expectation with your investors gives you more flexibility to be able to operate properly. And the last one is outdated technology. I see this a lot on deals we're acquiring now where they are not leveraging AI technology. How many of you are using AI? Okay, awesome. Every hand should be up because if you're not, you are easily missing out on one of the easiest ways to generate income on an asset with very little to no cost. And I actually have a toolkit I put together. In there, I have a list of like 35 different AI tools that we either use or have done demos on that you can leverage. And there are so many ways you can implement AI, right? You can implement AI from marketing to underwriting to asset management to capital strategies to investor relations. The ways you can implement AI is countless, and it's a great way to add productivity and efficiency to not just your deals, but also to your companies without adding a lot of cost because a lot of these tools cost a few dollars to a few $100s, maybe a few $1,000s if you're using some of the underwriting tools that are more robust. But it's a great way to add and enhance your team and scale your operations and your business. But you still need to be able to think creatively. Right, and so I wanted to give you guys a case study of how thinking creatively and thinking again and unlearning can put you into the mindset of making sure you can solve problems more efficiently. So I have an asset that we had no free cash flow on. Okay, we were running it as lean as possible. We were watching every single dollar. But we needed to increase occupancy. And what we knew to be true after researching and looking into it is that our tenant base was very strong. We had great tenants that had great employers. Our bad debt was very low. So naturally, when we wanted to increase occupancy, I want more of those same tenants that are well-paying tenants, qualified tenants that are taking care of the asset. So how do we get more of those tenants? Referrals, exactly. We want referrals. I want you to bring all your friends and tell them how much you love living here, which is really hard to do at an apartment complex, right? And so you have to create community. And one of the best ways to create community is to host resident events. And we wanted to host resident events, and we knew that the demographic was a lot of young families. So we went to the property management team. We said, hey, of the resident events we've done, what's one we could do for next month that would be really fun, that everybody will want to come to, everyone will show up? And they said, well, Halloween's coming up. Let's do a pumpkin carving contest or pumpkin decorating contest. I said, amazing. That's what we're going to do. So they're like, okay, great. And I was like, and you have no money to do it with. They go, um, we appreciate that, but how do we host this with no money? And I was like, well, we're gonna have to figure out how to make something from nothing. We're gonna have to, what's the saying? You have to squeeze blood out of a turnip. So I told them, I was like, all right, I'm gonna think about how we can do this, and I want it to be really great. I don't want you to cut corners. And they're like, okay, got it. So don't cut corners. It's gotta be great. It's gotta be engaging. Everyone has to wanna come, and we can't spend any money on it. Okay. So here was the solution I ended up coming up with, and I went to them, I called them the next day and I said, okay, I thought about it and I know how we're gonna pay for this with no money. They go, okay, how? I'm like, we're gonna get someone else to pay for it for us. And they go, okay. So I told them to call every single person we've ever spent money with in the last 2.5 years that we've owned this asset. I'm talking about the broker, I'm talking about the debt lender, I'm talking about our landscaping contractors, our pool contractors. I said, call every single one of them and tell them that we need them to sponsor a resident event. We'll give them their marketing, their advertising, and they have to give us between $500 and $1,000 to sponsor this event, and the future of our relationship is contingent on this. So we voluntold them that they were sponsoring this event. What happened was we went back to all of these sponsors well, they didn't know they were sponsors. We knew they were sponsors, all of these vendors, and every single one of them stepped up to the plate. Because for them, spending $500 or $1,000 to keep these tens of thousands, sometimes hundreds of thousands of dollars in contracts makes all the sense in the world. So what we ended up doing was we ended up getting this from multiple vendors, and they were now sponsoring our resident events, which allowed us to pour more into the community without spending the dollars to do it. Now, had I relied on the information and best practices that we had in 2020, when we didn't need to do this, I didn't need to worry about resident events back then because the market was just carrying everybody, right? So if I had not gone back and unlearned what we knew, if I had not rethought about it, if I had not pushed myself to be more creative, we wouldn't have come to this solution. And so the best way that we can insulate ourselves from downside and insulate our investors from downside is by giving ourselves the opportunity and the challenge of rethinking what we thought we knew. If you think you know something, I challenge you to rethink it and see if there's something new you can discover. See if there's a new perspective that you can learn, right? Because new perspective gives us new opportunities to think outside of the box and think creatively and show up better and gives us a competitive edge. We owe it to our investors to always be willing to rethink our strategies. If we get stuck and stagnant, that's when we and our investors start getting hurt. Okay, you guys are not going to be judged by the mistakes you made. You're going to be judged by how you respond to them. So I encourage you that in this storm that we're in, to show up as the buffalo and not the cow. And thank you so much for your time today. I'm Veena Jetti. I'm the founder of Vive Funds. I appreciate all of you. Thank you.